Hello and welcome back. We haven't done one of these for a while due to me being on holiday and various other things, so it's good to be here. Hopefully you're going to throw loads of comments at me, questions, and we'll try and deal with those as we go along. The Alpha competition is back. Hopefully you can see that. There'll be info coming on to the Discord in the next few days, but basically it's a freebie even if you're already a live member, whatever. The whole world, take them on the month of October. The top 30 places get qualified accounts. So not having to go through an evaluation, you're actually live straight away, day one, ready to earn some money. So this is probably one of the best competitions that's ever been out there. Get involved. First prize is a 50K one. You've obviously set 2 to 5, 25s, scaling down to 10s and 5s, but this is live money. Don't remember that. Qualified live funds and the ability to have profit share straight away. So take that seriously, get involved, put your skills to the test. It'll be based on a 200K account, and the details about registration are coming up at the end of next week. So we've got someone there. I am you, and what I see is me, first, second, third. Fantastic. Let's hope you take them all. But there is only one entry per person into that. So give it a try when it comes up. Definitely worth a go. So I am you, and what I see is me. Have you got a question? Any questions? What's been going on? We've finally got to the Fed cut. Hello, Vinny. Become rich. Yeah, that'd be a good idea. So comp is back. I was going to just run through a few things that I've been looking at. We've obviously got that H2 seasonality for September coming on for the indices. Has what the Fed's done anything to change that? There's no direct giveaways today on here. But if that is something that you all want going forward, we can try and arrange it. The competition, the details aren't out yet. It will be there before the end of the month. So look out for it sometime towards the end of next week. But definitely enter. That is a fantastic prize. I think a lot of what's happened puts us in the 1990s. If you go through listening to lots of people that are out there, it feels more akin to insurance. And don't rule out the fact they may put rates up if the data goes the other way. Powell was very keen to say that, but at the moment it looks like they want to get ahead of the game, which is what we were looking for. We'll talk about the bonds. DXY itself looks like it still needs to go through 100 before it finishes the current move off. Gold, that again itself is close to a top. And then we'll have a quick look at FX and see how that should sit fundamentally, but it's probably yen is number one, Aussie dollar, they're not moving. GBP, we're at a record high since 22 today, and it's come off it a little bit, but there's every chance we're going to challenge those 21, 22 highs. And China in the mix. China has now got the opportunity to cut up to 50 basis points, which they were crying out for from the States. So they didn't do anything today, but they've got a little bit more wriggle room. Bitcoin, which you can trade on Alpha Futures, but not on Alpha Prop. That looks like it's about to squeeze out. There's a lot of forced sellers in Bitcoin at the moment. We'll have a look at that. I'd like to remind you about the stick to the rules, get paid. That's what everyone's talking about. There's a lot of Twitter nonsense still, but they're a very small minority of people who in the main haven't behaved. Go through the payout, proof of payout on our chat, and you'll see just how many people are getting paid out. George keeps putting out some great stats, just how much we are paying. We went through the $50 million payout. So Alpha are here to stay. We're doing it properly. Free Trade Hub. You know that recession is coming. Do you have a backup plan for that? What do you mean? Alpha Capital, the market, me, you, the world? So obviously, there's a lot happened this week, and that is going to be the debate. Is it because they're scared of recession? Is recession going to happen? Have they actually gone to gone too early rather than being too late. We've had lots of discussion about which way they are. Deep G, I'm a cheeky man. Cheeky man. Well, it shouldn't affect us. We've got a nice, robust trading model. We're very happy to help you achieve your aims alongside ours. So, yeah, we're in a trading situation, and it's all about whether you guys manage to outperform. Beggars want one 10K account. Okay, become rich. I mean, really, you should be concentrating on just doing this nice and slowly. I don't know if any of you have looked at alpha futures yet, but that's a very good way of creating discipline into your trading. And we've also, via Ben, the COO, who himself is a live funded futures trader at Top Spot. He's put some very, very user-friendly things in there to make us probably have the best offering on the street. And there's a lot of safeguards within that so that you don't blow your accounts. There's a 2% cutout on a day. Each day you've got a trailing stop loss, trailing maximum loss limit to keep you nice and safe. There's a consistency rule to stop you going for the one-shot win. And obviously you've got better pricing, more secure pricing, etc. Competition is throughout the whole of the month of October, Deep G. So you've got to get your trading hat on, lots of discipline, build that account, and the top 30 get paid out with a qualified account. So I thought we would just have a quick look through something. Let's have a look. See if you all remember it. Maybe we might have it covered up with something. Never mind. For some reason, that has disappeared between me setting it up and starting on here. No, you can't see that. Damn. Never mind. I was just going to say the seasonality. I'll put the chart back in the weekly preview again for next week. But I keep talking about it for indices. In normal years, for the last 50 years, the last 2 weeks of September are normally down weeks, and we're now into those. Despite the fact that we've had a little bounce up, we've challenged new highs in the S&P. The tech market had a big bounce, SOX and NASDAQ, but they didn't put in new highs. We're not quite there yet. So there is a chance, and particularly in presidential years, we've shown the chart before, where they drop off. Annoyingly, we can't show that at the moment. So just tread carefully for the next couple of weeks. October is generally a much better performance into the election. Again, election years can be a bit choppy. So we are going into a period that is difficult to predict too much, apart from the fact we've now got a very investor-friendly backdrop for indices. We've already got earnings running at a good level. Kind of, to me, we're mid-cycle, so we're not near the top yet. A lot of people are trying to say it's the end, blah, 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 and there is a recession coming. I don't think that is the case. So when we look at charts, I think we've still got at least all-time highs to come on those tech indices before we blow up. I think there's a few people gone a little bit early, but just be careful the next couple of weeks. Deep G, it won't let you sign up yet because it's, I said it's going to be towards the end of next week. If there's something there, it's just a tester. So just look out for announcements next week when it's time to go, but just be aware of it. You want to be involved. Free trade, your country's restricted. Are there other ways you can trade with alpha futures? I don't know. You'd have to ask the moderators on that. If you're restricted, as far as I know, you can't trade, which is a shame. Have any of you guys got any thoughts or questions on what's been going on or what you're expecting in the next month? What do you trade? Give me a shout. Show me what you're trading. So Deep G, you trade the NASDAQ. Okay, we'll have a look at that in a minute. So as I was saying, it's very much like it's sometime in the 90s, early 90s, mid 90s, when they were a little bit scared about things being too tight. They'd stopped the fiscal spending, which is what everyone's trying to do now when the debt was getting out of control. They thought they were going to have a recession, so they cut rates, and then everything just carried on growing and growing, and they ended up having to put them up a little bit. It was just like stoking an already raging fire. That's what people think may happen with this. So we'll probably get a breakout in indices, carry on breaking out in gold for various reasons, physical, but also the fact that they may have made a mistake. So there's every chance of monetary inflation. Bonds are probably too expensive. Deep G, what do I mean by cutting rates? So we're watching this week the Federal Reserve. So they literally took their interest rates down by 50 basis points, which is 0.5%, from 5.5 to 5. So when you cut rates, you're literally taking down the amount that a bank would have to pay to borrow money from the Federal Reserve itself, and then that flows down through the system to what you could borrow money from the banks, and if you're doing mortgage rates, etc. So they generally flow through. The mechanism is something they call swap rates. So people look at different expiries of those bonds and they work out exact year differences between them, and that gives you an idea where the rate should be for borrowing for whatever length of time that suggests, i.e. 1 year, 5 year, 10 year. So if you've ever taken a loan out or you've got a bank account, you might know what those things are. But generally, it just makes conditions a little bit easier. And in terms of financial instruments that you're trading, like indices and bonds and things like that, the future value, if you have to be discounted back to today's value, and if you've got lower interest rates, you get a bigger value. So markets tend to go up, ignoring everything else, if you've got lower rates. Does that help? So for instance, yesterday, everybody was looking for growth plays, things that would really benefit long-term from cheap interest rates and lots of money coming in. And that was like the semiconductors, NASDAQ, the bank indexes. It was all very much a risk on. The Russell 1000, which is their growth index, was a big outperformer yesterday. Very good question, Afri Trade Hub. Do you think that currency is at risk of being overtaken by digital money, etc.? Well, it's a very good question, and there's a couple of events coming up that will have an impact on that. In October, we've got the BRICS conference, the Brazil, Russia, India, China, South Africa, who are trying to create an alternative settlement currency to the dollar. And they've got another 60-odd countries applying for membership, which adds up to about 2/3 of the world's GDP. So that is a very, very imminent threat. And that is going to be based on a blockchain technology and backed by 40% gold, is the rumor, but we're going to have that confirmed soon. All the central banks themselves are testing what is called CBDC, central bank digital currencies. So that's all based on the blockchain technology, which Bitcoin is based on. So yes, I think it's kind of unavoidable, but is that going to be the death of Bitcoin? I've just been doing a piece on a Bitcoin miner, and I think the net of this is that once the blockchain comes to the next stage and it's going to be used internationally, you as a consumer have got to think, why was Bitcoin brought in the first place? And that was to avoid having centralization control where it can be manipulated. So rather than be the end of Bitcoin, it might be the mainstream acceptance by the global population at large, because they'll believe that they still want to be decentralized, still want to have something that can't be spoiled by the central banks, etc. So it could well be the start of a big breakout for Bitcoin when the BRICS currency, which will be called a unit, when that's announced. So look out for that. Things could get quite interesting in the next few months. It's all based on de-dollarization, which is people moving away from the dollar. So we've lost the petrodollar agreement with Saudi Arabia. That they no longer are committed to paying for oil in dollars or receiving dollars for that oil. They can trade in whatever currency they want. And then obviously the way that the Ukraine war and Russia had lots of things confiscated in dollar terms, and that money is being used against them. So that made China particularly get worried about its own exposure in dollar-held treasuries. And ever since then, they've been selling those and buying gold. And lots of other central banks are buying lots of gold. And if they want that to be a reserve asset, it's my go-to phrase, they have to own 85% of gold physically. That is why there's a huge demand for gold and why the price is getting pushed up. But we'll look at that again in a minute. So yeah, very good question. And I think there are big risks. But the problem, what everyone's got to remember though in this, it won't be overnight. And there's so much debt priced in dollars globally, which is why it's always stayed as the main currency. It's going to be very difficult for that to change overnight without huge amounts being written off, etc., putting people into recessions. That'll have to be managed. So that process will take time, and the Americans will want to do something to still be involved. I think underneath, they're quite happy if someone else revalues gold, because it will give them an excuse to pump that up and use the pretend money to pay off the out of control national debt. But we'll wait to see whether that happens. But short term, at the moment, people are thinking interest rates are going down. The Fed have said unless anything changes, they're going to cut another 200 basis points, another 2% by the end of 2026. So that is out there. The market is already priced for them to do more than that. So rather than having to even cut the rates that people are trading at out there are already factoring it in. So that in itself creates a self-fulfilling loop for the investment world. The Fed just needs to manage it nice and gently. I think they did well this week. They got ahead of the curve, communicated it. Everyone's going to have their own views around it, but the central theme is that they've started and everybody's on the same page. Even Michelle Bowman, who dissented, was 25 bips and voted for suggested numerous cuts for the rest of the year and next year. So she was only dissenting on the first big cut. So looking at it, there's things like the UK didn't cut this week, and it was difficult. And we saw today they had strong retail sales. The services index was below their factored in number of 5.8 growth at 5.6 when CPI figures came out, but it's still on an upward sticky path. So they've got plenty of time to wait for the data to get worse in the UK. And even Catherine Mann, who's the deepest hawk on that committee, said that she'd rather wait to get it right, and then there's plenty of room to cut large, which is what moves me on to the next point. Is I think interest rates in the UK will have a big catch up at some point. So in the short term, sterling may well move up, GU, etc., challenge previous highs, even if it really gets hold. If there's any rumor that they're not going to move in November in the UK. But eventually they will end up coming back towards each other. But it certainly leaves it open for sterling to rally in the short term. So don't get too carried away in the short term of them catching up. Do I still day trade? Yeah, sometimes, mainly on my SIP, my pension account. That's where most of my money is tied up, but I can trade around on that. I just mess around on the demos, really. But again, if you've got an opportunity, the platform on Alpha Futures is absolutely brilliant. So if you trade any of the dollar pairs, the dollar indices, commodities, and it gives you the chance of trading bonds. If you've got a macro view on anything, then Alpha Futures really is a product I'd push you towards. It's fantastic. The GUI is fantastic. You can open a trade, get your stop losses and take profits on there, move them around. Eventually, you'll be able to do that with one click on Trading View, but that's not set up yet. But once it is on there, on the Trading View window, I might have a look at that for you in a bit on the demo. But it's brilliant. You can drag things around, close your positions. You've got lots of protections. I think it's a fantastic product. So first question earlier was the dollar, wasn't it? DXY. So I haven't really updated a lot of my charts. I thought we'd look at it today just to see how they played out for last week. So you're looking for the dollar to come for that previous yearly low, yeah. Depends which year. You're talking near term in the 20s or way back in 2014. You wish after free trade, you wish you could add a match trader platform. We'll put that onto suggestions. The guys do listen and they do implement things after they've tested them if they're any good. Right, yes, I agree. The 23-year low, the 2023 year low, which is that should be over there. Yeah, definitely taking that out without a doubt. I think 98 is the target for what I'm looking at before we put a consolidation in. So as ever, with everything that was going on around the Fed decision, you're always going to have that breakout. We got the lower low that I'd been talking about before I went away on holiday. When I went on holes was all in this period going into that low, wasn't it? And back again. And I'd said that this could either develop into a double or really a failure would get us into this new breakdown. A wave one, that now is wave two. The lower low confirms we're in wave three. We've nested up and we're now making our way down here again. So I'm looking for a challenge of the long-term channel that we're in. So I think we're in this ABC down, of which you correctly identified the 23-year low is quite important. And that will get taken out, I think. And we'll break this lower channel that needs extending across here, actually. So I'm looking for a test of this channel for the whole move to get tested. And that takes us all the way back to the current wave down started in April. So we're still working our way down in that. We're in the third wave. The low in August was the first of 5 waves down. So we're in what should be a quite powerful one, which is why I think we break 100 properly and go down. There'll be a consolidation and then put in what will then probably be a decent bounce. That may well be if Trump gets in terms of timings. It'll probably be over here around late October, November that it starts happening. All his policies are being deemed in the media as being uber inflationary, in which case we'll start seeing a bit of pushback on rates. But in the near term, we've got enough space to potentially get enough to support a risk asset rally, really. It's all about getting through the next couple of weeks without too much damage. And it may well be that we just ignore it, but look out for consolidations generally. But I think that's all they are, not crashes, not the normal seasonal blow up. Yeah, Kamala is Trump light in a way. Neither of them are sorting out the fiscal side of it. It's just that Trump is pouring fuel on the fire. So backdrop, dollar should be fairly weak. So even though some of the pairs may be having consolidations, again, I don't think they will last for too long. So I've got a lot of data coming up in the next week or so, haven't we? Mainly European. Next week's it's pretty quiet apart from PCE for the dollar, which we know. Once you've got CPI and PPI, you've got most of the inputs to PCE, so it shouldn't be a shock in any way. But to me, we got a nice three-wave consolidation while I was away and back in the euro, and we're playing out into some more upside, even though we're getting a bit sticky. We've got to take out that previous high in the 112s, but I think that will break at some point soon, and we're into open territory. 115 is an area I've seen a lot of people talk about. But just, don't get carried away with sells here. Obviously, this is a stop loss down here at 110, but we're a million miles away from that at the moment. But that thing, you should really be buying with that as cover if we get any pullback in the next few sessions. I said sterling is interesting. We went to a recent high this morning on the strong retail sales number and the comments from Catherine Mann. Got the whole thing bouncing again off this low here. She started speaking at 10. But if we look at that in terms of the Liz Truss moment, which should really be the quasi-quarteng, kamikaze. So when the sterling was strong and we were going through that inflation phase, obviously the UK's inflation problems are worse than the US ones were because we import a lot more. Some situation, but here we had the quasi moment where we nearly went to parity, and that is a significant low that we've been coming out of. We've had a one with a consolidation. We are currently in probably a third wave of 5 up. So this is probably where it fails, a challenge of 142. So it's really the long-term bias is up. It's just a case of timing it on those short-term scales. But bear in mind that the US is so overvalued from the rate side that they may well see some rate strength as the next 6 months unfolds. And sterling is priced for everything still being rampant. If you get any kind of weak inflation data on the services side, then the Bank of England will probably do a 50 basis point cut, just because they know they're relatively behind. So it's we do need to really watch the data mix versus US versus UK. Euro wise, they're in a strange position. They have said that they've downgraded for the next 2 years, and without showing where the supposed inflation is, they've not cut rates. I just think they wanted to see the state of play from the Fed, and then they cut rates, but they didn't cut the inflation rate either, and they didn't project it. They just said they'd go data dependent, which everyone's found quite strange. But they will have to play catch up. Look at everything that's happening China-wise into Germany. Germany's tied themselves too much to China, and they're now suffering on the auto side, luxury side, the whole shebang. Free trade. Where do I get all this information about rate cuts might bring about bring about on the market? Well, it's just a case of reading through, listening to commentary on the business websites, reading through articles. And then I've been doing this for 30 years, so I kind of have a good feel for how things will react. I've been through a number of cycles, so I have a feel for how things play out. I said, managing to read some of the strategy notes from Goldman Sachs, JP Morgan, etc. over the last 6 months, we've covered them throughout these things. Seasonality is a big thing. It doesn't always play out, but it's good to have it in the back of your mind. What normally happens over longer periods doesn't guarantee it, and often, which is why you need to go away and check data. Don't just look at the headlines. Go into the depth. Is that some of those things can be biased by just one or two outlying recession events or crashes. So you take out 2 or 3 of the biggest moves seasonally, and September isn't as big a road crash as everyone thinks, which is what might catch the market out this time. Is I think a lot of the market is holding off for October before they buy, and yet the market is squeezing post the cuts this week. So there's a good chance that in time-honoured fashion, by the time we get to October, the market might be 5 to 10% higher, and we go, damn, what do we do now? We've missed it. So just be very careful about selling the market on seasonality, but just be aware that it could sell off. Right, does anyone follow gold? So if we zoom out, I'd said for a long time that I was staying with the fact that we needed one more high. When we put in the all-time high here in July, a lot of people called that as what I've got labelled -3 up here. So I do wave theory. The highest wave that would have been minor wave 3, in which case we would be looking for a substantial pullback as a wave 4, and then be moving on to the red wave 5, -5. But I didn't think this was enough to finish, and I was still looking for this one to hit this 25.46 minimum, which is a fib 2.618 wave, which I've mentioned that late last week as being a potential stopping point, despite the fact it didn't look exhausted. That was based on a higher degree 234 parallel channel, which is the big black channel, and it being at the base of that, which is something that, as I said at the time, often it comes up and kisses goodbye to it in a real sloppy finish, which is, it wasn't really impulsing away too much. We've broken that out and held it as a low, so that brings back in what I think that was right in the first place. 1, 2, 3, 4, 5. We're playing an extending fifth wave, and Gustav on our chat has been playing the same thing, and has, I think, hopefully hit his 26.13. These blue waves here, the minuet waves, so the minute waves and the minuets. No, sorry, again, you get all these silly words. I always get them. Subminuet and minuets. The blues are minuets. The lower degree is subminuets. The red ones without any brackets. Both of those are in a fifth wave, and each of those fifth waves are these parallel channels. They're a confluence here where the red circle is. So this is, if we're going to stop, we're right on an absolute classic stopping point, anywhere here between 26, 20, 30. And if it's going to put in one spot, 168, so 1.618, the classic golden ratio of the first wave, if that's the fifth wave, that takes us up to this black line here, 26.40. So we're in very close territory to finally having put in a significant top, I think, in gold. I don't think it's going to be a disaster pullback, but we are overdue some consolidation. September, again, isn't normally a big month for gold historically, so it would be appropriate if that did pull back into this sort of lower 24 area pretty soon before we build momentum into what is a strong period and going into that BRICS announcement blah, 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 and 3,000 by the end of the year remains my target and that of not a lot of the central banks. So be very careful about shorting the pullbacks. If you remember the way that we've traded all the way from that mid 1800s challenge in January, February, all the way up to here, there's been very few super big pullbacks. If anything, you've been whipsawed every time you tried to do that and got dragged to high highs, unless you were on short-term trading timeframes. So be careful here. Obviously, buying if we're about to go into consolidation, but can't guarantee just how deep a pullback that's going to be for the next couple of weeks. I'd love to see it at 2,400 in a break of this channel and a break of its own channel, upside channel 2,500 is a bare minimum that we're looking for. It'd be lovely to get it here into open territory to then whipsaw the bears. So for me at the moment, extreme caution on gold because it's hit my long-term 6-month confluences. We don't really want to. I don't really want to. I've changed that picture because it's played out. So I'm not going to fight the fact it may still extend higher, but I'm going to be on the sidelines for the minute. So I just think it's done enough. Even within this move here, there's 5 distinct waves. 1, 2, 3, 4, 5. That is classic finish. It ticks all the box. It's an A1 Elliott wave setup. It will pay. We really want to be buying a high degree 3-wave pullback, and then we will have, by definition, because we've got to put a red 5 in, there will be another all-time high at least, and that is a 5 of that will make a third of the higher degree. So there's 2 or 3 further significant all-time highs, which is why we'll be eventually back on this upper trend line here, which finishes up around 3,000. I'll redraw this over the weekend so we can factor that in. But yeah, be careful short term, but be looking to buy significant weakness. You lost a lot of money after trying to trade a pullback on gold. I mean, what? Waiting and missing the upside? I know it's very galling. This is one of those classics. When you get, well, if you were listening when we were talking about this in January, February, I'd said it was a whole bunch of what's called nesting, which is wave 1s followed by retracement 2s that don't go below the starting point of the wave 1. And they built up in about 5 or 6 different levels of degree. And this is still, this red 3 is still the kind of 4th degree. So there's 2 more to come. Before we put in a multi-year proper consolidation probably, but even that depends on what happens to this de-dollarization play. But this has completely changed since January 23. The central banks who no longer want to own gold suddenly changed, and the Bank of International Settlement and Basel III meant that you had to own gold physically 85% to be able to call it a reserve asset instead of the dollar. So central banks, complete turnaround. They now want to own gold and they have to own it. So physical settlement beats financial to a pulp, bias to the upside, net, all the nesting's happening, the big breakout waves of the 3s. That's why we keep exploding. The pullbacks are narrow. It's just when you hear that phrase, don't fight the trend, when you've got huge amounts of nesting, lots of degrees, that is a prima facie example that it'll be used for years to come as an example of how Elliott wave, etc., at least set you up for a massive swing trade and lots of trades in between. So any more questions on gold? Does anyone have a different idea? The power to how I look at it is I need to know what my alternative view is. The alternative view is that, as I said earlier, this was a significant top. The wave 3, the red wave 3 moves down. This becomes a very shallow short-term wave 4, and we're into a wave 5. Something to know about commodities is that they often have an extending wave 5. Most other instruments extend in their wave 3. That's where they do most of their work. But commodities have often had bigger wave 5s. Metals, not so much, but still more than other instruments. So this could easily be minor wave 4 here, and we're into minor wave 5 already, and this would probably be as a complete 5 swing that we talked about. That'll be the first of 5 waves to the minor wave 5 top. So in which case, expect a lot more upside quickly. Net, they're both going to be the same, which is one of the reasons why I didn't want to change it. And in fact, if that is a wave 1 set of 5, then the retracement could be quite deep as well. In which case, again, we end up with the same sort of scenario. It's either a higher degree wave 4 or a smaller degree wave 2, which end up having the same sort of amplitude, same sort of degree of pullback. So that leaves me with me saying, just look for a decent 3-wave pullback, similar pattern to this here that we had back in mid-July. That's the kind of movement we want. And what do we get out of that? 2487 to 2350. Yeah, 120 points off here. So we're back to 2500 to 24. Anywhere in this space. Like I said, if we could just overdo it, just for a bit of extra momentum when it turns. Obviously, dollar yen has been the carry trade. That was the thing that we all panicked about in August when big money came off because, and this is key to listen to the commentary this week and the fact that they've set out a pattern for the rate. So Japan put their rates up. That was expected. We were talking about that. What was unexpected was the fact that the US might suddenly have hit recession. They had those bad non-farm payrolls on the back of a weak ISM manufacturing, if you remember. So all of a sudden it's a case of, they've got to cut rates, but they've got to cut them in a series of 75s and 50 basis points. And there was potential for the 300 differential on interest rates to come off quickly for the United States, in which case that's take carry trade off. If you're going to suddenly do that, you go back to the levels of pre-COVID, and that was 100 on UJ when it was sat at 160 at the time. So absolute panic. What we've got now is 200 basis points coming off over 2 years in a controlled manner, and the ability to move either way data dependent. That's a much more sensible route, manageable, and it's already a roadmap that we can look at and play to. So the descent of UJ now will be much more controlled. Looks like they're set up to put rates up in December in Japan, but it'll only be 0.25%. By then, the US will have taken 50 to 75 more off, but it's kind of in the price. What we might get here is what we originally said. This could end up being a WXY double consolidation that possibly takes us down to 130. All depends on US election and that dollar pattern we said before, but that might be where we end up in the first part of 2025. We had a ABC connector halfway down. Again, we've done a lot of work here in the first instance. This pullback here, again, could double as long as it stays below that 150 level. So we could go back into the high 140s and still be valid before we start selling off again. But the crucial bit is the absolute nightmare descent of UJ. All risk off is out. It should be out of the way. Things should be more controlled on the way forward. That leaves a path that I explained a couple of previews ago, all about the large quant money that plays on low volatility. So as long as you get low vol and serial movements of plus or minus 1% per day in indices, which is the VIX at 16 and below, then they will just put huge amounts of money to work. And they only took it off when vol was high, and they didn't care what the in and outs prices were. They didn't care selling at 10 and coming back at 20 as long as volatility had calmed down. And that, to me, is what's happening at the moment. We've got huge inflows about to come into US indices again and the tech indexes. Agaga, Japanese yen pairs, I've always found them tricky too. I mean, we nailed this for a while on the chart, and this totally misinterpreted what might happen if the US suddenly had to go for 50 bips. It was the whole panic that they might have to go 100, 200 really quickly. And that just totally put a pin in the bubble. I talked about for ages to people to be careful of interventions, but if anything, Japan was really struggling to get their act together. They were trying to hold on for the US to help. The US were doing nothing to help and had it forced on them. So, yeah, I mean, the size of that pullback, I was hoping that this pullback to the sort of 152 level here, the double was enough there before we had the rally into the August blow up. Yeah, that became, once we got into this area here, became very difficult to manage. And again, we're sort of mid-range for the next proper breakout. So I try and let UJ rally a little bit more before I got bearish. And again, for it to go high, I'd like to see this movement probably consolidated at least 50% and go again. So it's a classic. Again, just be careful on UJ. Look for a little bit more extreme before you play both ways. I think we can afford to play other instruments at the minute. The fact that the UJ is rallying a little bit tells you that you can play a bit of risk on more. And again, right until that blow up, we did call that as a bounce. Where are we? So this area here, late July, we said that looks like it might dig in, but did not expect the UJ there. So we basically went from being the highest performing risk asset in the world at the time, I think, to suddenly being down on the year, all within the space of 2 weeks. It was incredible, wasn't it? So that second down leg, nightmare. But classic V-shaped recovery into what was a MACD super low as well at the time. And we've not had anywhere near a challenge to that as a secondary low. Again, we'd like to take out this 39,000 level just to get a higher high and hopefully lean us towards ultimately putting in an all-time high, by the year end. Just with all of these indices at the moment, we just need to confirm and hold some breakout levels because it still could be failure to putting in a new lower low, which is that is the worry. The September half two seasonal disaster would be a very sharp sell-off. Feels a bit like it's too late for Travel and Arrive, but are people going to commit money in this period? Again, I lean towards the fact that we've seen it off, and the fact that we've put in insurance for the index side of things. It's the bonds that I'm more concerned about selling off, and any yield pushback will be interpreted as being the recession not happening rather than it being a valuation worry for equities. So there will be a lot of nonsense said on that. So yield pushback on bonds, that'll be stronger dollar. So that might cause us a little bit of, even if this is going up, we might get the retrace here, but I wouldn't panic. I'd have in mind of all of these charts, when we look at them, the rally low, which here is 35,000 on the Nikkei, and we'll look at it look at where it is on the others. But that is your kind of stop loss and view change. Prior to that, we're still consolidating for breakout. And we saw how choppy it was post the Fed decision on Wednesday. The 2% rally disappeared. The volatility is in the market. We've put it back on again yesterday. We're trying to consolidate that today. And be careful of reading too much into today's action, because it is triple witching or quadruple witching. Does everyone know what that is? So triple witching is the expiry settlement price creation by the end of each quarter. It's the third Friday of each end quarter month, so third Friday in March, June, September, December. Some people call it quadruple witching because the triple one is the indices, stocks, and options, indices, futures and options, and then stock options, but there are also heavily traded stock futures now. So some people call it quadruple witching. So the final hour is when all the settlement prices get worked out, really. So you'll have lots of volatility. They call it kind of under-over trading. People have got exposure at various levels and prices, and they'll be fighting to try and put their derivative instrument into profit or others into loss, etc. That happened at 10 past 10 to 10:15 in the UK. So you often see a lot of volatility in the FTSE at that point. But all the action there is on. So look out for a lot of volatility tonight into the close in the US, and probably ignore much of what we get as a result. So Germany, can we see that? Let's try and put that up. So DAX, again, August the 5th was a wave 4, which puts us into wave 5. Haven't quite, have we taken it out yet? Yeah, so we have taken out that previous wave 3 high, which happened in May. So that's really good news, despite all the absolute negativity that's going on in the headline. We've got Volkswagen shutting down a factory for the first time in 80 years, the autos all getting smashed to bits, GDP and all the industrial production stuff in absolute negatives for Germany because they're so aligned with China these days. So we ended up redrawing this, if anyone remembers, to make it a larger degree 3 swing, a WXY, to make August the 5th the wave 4. So it's quite instructive that we put in a new high for the move. That's consolidated, and again, through and against all the negativities that's been thrown, we're putting in another higher high, which gives me more and more confidence that this is just a consolidating pullback here. If you just look at that, it's been hanging on to its 50 period average. We've just gone to sub part of that. It doesn't tend to get too detached from the 50-day moving average. I'd expect the DAX to dig in within 1%, maybe 2% or so from here, if not turn today if the US changes. But we're very late in the week. But look for any kind of pullback to be a buying opportunity in the DAX, because they've now put in sequential higher highs and higher lows, and that in Elliott wave theory is nesting 1-2s to 1-2. This is looking like 1-2. Stand by for 3 over 3. They're big moves out. So that's giving me a bit of confidence that the DAX is looking at and climbing the wall of worry, as we say. What's my social media page where I'm also active on? I'm only really active on the alpha chats at the moment. We'll have a few videos coming up soon. We'll try and we are thinking about doing some more actual longer live trading sessions in the US sessions, but we're discussing that in a strategy meeting next week. So we'll decide how we're going to do that, but we may well have a longer session where we'll trade a few instruments for you But it's like come to my Discord channel, Market Watch with Planty, ask questions, look at stuff, and I've also got, I'll make it live again. There's a page on there that tells you which fundamental things to follow. So it's a good start. It gives you a good idea of how to look at fundamentals and why those fundamentals are important to looking at prices. Sometimes fundamentals are in charge, sometimes technical, sometimes we're looking for a confluence. We're obviously looking for when there's a difference and trying to identify which one is wrong. That's often a key issue. But I strongly advise you to try and look at both. It's limiting to look at either on their own, and it's more fun to look at them both, and you feel like you can cover more instruments and understand more failures of when your setup goes wrong, which you've got to remember can be a high percentage. 51.49, I keep going about it, is good, particularly if your risk management's good. Obviously, we're trying to get that win rate as high as possible, but you can have a good strategy, and if your risk management is poor, you're going to struggle anyway. And your risk management often comes from knowing what the alternative scenarios are, which is why you want to be on top of the fundamentals. Anyone that comes on and says, what data have we got out today, guys, blah, blah, then you've just been too lazy. You've got to look at the calendars. Look at the calendar every day, a week in advance. Look at my preview, other people's previews, just to see what might be something interesting to keep in the back of your mind. The power of what I look at, Elliott Wave, as I said earlier, is giving you what the alternative scenario could be if your setup falls down. You're already looking at it in advance rather than having to recreate your structure. And you can overlay support and resistance, fair value gaps, order blocks onto this. That again gives you powerful areas, and if they line up with fib retracements and defined wave structure, then you're getting strong confluences. So Nasdaq, not really, it's only down a quarter of 0.2% at the moment. So it's not really much at all. Again, I haven't really touched this because I wanted to just show you how it's moved since we last updated it last week. I haven't touched it this week just to see how it played out. And that, again, we haven't taken out the wave 4 low. That's an overthrow to its 234 channel that we've drawn in. I anticipated that from 2-3, and the fact that 4 came out where it did gave us an idea where 5 potentially could be. So far, we've put in a nesting 1, 2, and what looks like maybe a 1 already. Certainly, there's 5 swings in that, so this could easily be a 1 up to yesterday's high. Just consolidating that, which is why I've got an arrow in there before we take off again. Ultimately looking to touch the top side of that channel, which is 22,000 on Nasdaq spot. So keep that in mind, and we're just touching on highs for the move, aren't we? So we did take that previous high out yesterday, obviously consolidating back within it. That could be a 3-wave move already, but I lean towards that maybe being a 3, consolidate, another 3, and then we go. But be aware, I'd rather, if you are going to sell it, obviously yesterday's high is your stop loss, because if we take that out, we're going to break quickly. In here, obviously, it's a tentative buy on a week 3. That could easily do a double extension. So from the previous high to that low. So 1 for 1, 19,600, which is what, it's only just over 1%. Really, maybe another % off from here is the proper buying spot. But I wouldn't put you off necessarily buying that in here just in case it doesn't drop back. But I'd really prefer to get the 3. Keep an eye on it. That's our daily. This is always good for the if you've got sore eyes and you have to look. This is the one. Can you get a messier chart than that? Volume profile. This is interesting now, isn't it? That for ages the April low had all the volume, and when I went away, the volume was pretty halfway-ish at these high levels. Looked like it was going up on week flow, but we've started to put in a lot more volume into these pullbacks, very strong pullback zones, the support zones. This blue line in between, that is our 50-day moving average, and 0 is 50. So we're into what were our previous really strong going to all-time high levels, and we're still below those all-time high extremes. There's still another 10% of above the 50-day moving average to come for the S&P. So that could just be enough to put in that all-time high breakout we're looking for, which again, that should be over here. So if you noticed overnight, but 6,100 has suddenly, 6,100 suddenly appearing on a lot of strategist notes. When previously they were sort of 57, 57.50 as the highs for the year. So that is quite encouraging. The whole question is whether we get any kind of pullback. It's sort of running out of time, running out of road for it to be anything super big for September, but we shall see. Again, if this is subdividing, it doesn't really matter as long as 5,400 kind of holds. So upward bias path until we actually go bearish. We can afford to wait a little bit to see if we get any material trend change. AlphaTrade, does Alpha Capital offer job vacancies? I hope so, with the amount of people that keep sending me their CVs and stuff. I'm not the person to contact, unfortunately, but we are in the process. I've seen it on the Discord of setting up a Alpha Roles page where you send your email and number to anonymously into the team. We've got an internal chat where that will register on, and then people will contact you about jobs. So look out not only for the competition, but for that actually appearing. And that will make the process a lot more streamlined. So yeah, if you are interested, make sure you throw your details on that. But unfortunately, when I'm trying to send them on to people, I can't guarantee those people are still around. Alex is inundated, so he might not necessarily see it, etc. So we're centralizing it, and that will be again in the next week or so. Stocks above the 200-day moving average is the blocks at the bottom. We talked about here at the lows in August. Could that just be a one-off, just because everything has moved in one positive correlation? We needed to see it do a pattern like over here of sequential days. Otherwise, we're going to rally. And look, we've got the rally, haven't we? We've cemented, we've dug in, and now the fundamentals are going our way, and we're looking at, we're already into all-time highs. We're consolidating that, and I think we go higher. Let's see whether I've got the trend channels on or the others. If not, I'll put that on next week. That was the daily chart we were looking at before. Now I need to update that one. So I'll update that for Monday and the preview. But just keep your eyes peeled for decent three-wave pullbacks in all these things. That's I think they're consolidations for the moment. Won't bother with the Dow because that's all the FTSE. Just quickly look at oil. So we talked about that before I went away. So as you can see there, we had a major top in April, which is a consolidation of a move down. We're in a, let's see if I can find it. Shows you how high oil got, doesn't it? So from that 130 peak in the early part of March, then we had rates slammed on, demand destruction into very much that low in March 23, which we consolidated to September 23. And then since then, what we thought earlier in the year was just a consolidation pattern pretty much looks like 1, 2, 1, 2 down. So yeah, from, I don't know why my labels disappeared. That was a 1, and then we've done a 3-wave consolidation to a 2 top, which we're now doing 1, 2 and 1, 2 again. Now in the short term, we said we'd put in a lower low on that 5th of August, and we're right into demand destruction here. When we were in that period there, remember we were talking about it could still just be doing an ABC, blah, 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 putting in another challenge of 89.90. But momentum took over. We put in a 5-wave move down. 1, it's consolidated. 2, lower degree 1, 2. And the argument now is that enough for wave 3, or is that a lower degree 1? Remember, the 3rd wave should be bigger than this first wave here. So I would expect there to be at least another low, which is going to take us into the mid-60s. And really, the whole setup for this of 5 of these blue waves down is somewhere down to sort of 45, 50. That is complete and utter global recession, demand destruction. You'd like to think that is in the back of the minds of the Fed taking insurance, et cetera, et cetera. That won't really be driven by the US. That's continued China and European blow up. But in the very least, I think we're going into the sort of termination in the low 60s of that as a 5-wave move. You just need to keep an eye on it. And that is the 5 minor waves, the reds into the 60s. That will rally. And then it's just a case of where the 5th comes. We'll probably get the 5th around the same low, just a little bit lower. But there is an ultimate case for this whole thing. Even if it were to do a 2 times fib of that wave 1, that would be 58. So 2 spot 618 obviously is a lot lower, which would be the next proper fib. So there's a lot of angst still built into oil. And remember, demand destruction, and OPEC stupidly kept their cuts on for too long and let America and others take over the pumping. America wants to pump as much as possible into the election to keep it low, which always helps the consumer. When they see low fuel prices, they tend to be happy. So I don't expect too much more of a rally. That will start getting sold aggressively in the high 70s, I think, if it gets there. So that is interesting as a chart. So the move index is the bond volatility. Bond volatility has come completely out of it because they've been going the same way. The long bonds have in general, the longer time frames being bought and the shorter term ones sold off. So when they're moving in the same direction, the overall volatility falls. So that has come back into that range we're looking for. Which on a 5-year basis, that's kind of running slap bang in the middle. Now the VIX over here, that's the one we said we wanted to see back down to 16 to be confident. When it was in the 20s when I last spoke to you all, said we'd like to see that drift back. That would see all that money coming in. Remember, on volatility, annualized volatility, to get to daily volatility, you need to volatility squared. So you need to square root it back to the days. 250 trading days generally in the year, roughly. Nearest square number is 256. That's 16 squared. So in the markets, you generally divide the VIX number by 16 to tell you how much it moves. You're expecting something, the S&P to move per day. So we're back into that risk on mode of plus or minus 1%. That's money put to work. So we should continue to see inflows as long as we don't start crashing. and that is just confirming the whole VIX channel for us. We're back in the channel, the downtrend channel, since the start of the second leg down in the S&P. Once we got down here into, where was it? October 22 highs, into here. We've been really downtrending, take out the occasional risk off spike. It's mainly held that downtrend. So again, we said months ago, we want to stay, we don't want it to get moving into greed, which is when we start getting towards single figures. But this 16 to 12 area is proper risk on. Free trade, it's very good. So I know this might be inappropriate. I'm hard to get a job here due to corruption. I would love to work for you, at least start with. Yeah, well, send in your info to. Well, anybody can send stuff into me, but I can't guarantee that everyone's going to look at it in the short term. But definitely, when it comes up, send stuff into the new Discord channel when it comes. But yeah, send anything over, sir. Not a problem. Yeah, and as I said earlier, Bitcoin, hopefully that's popped up. Yeah. You can trade this on our futures platform, Micro Bitcoin at least. This here is a consolidation. Slight overthrow recently, but in general, we've stayed in that channel. I think that's probably a low that comes out. So what's been happening is, with the price relatively so low versus the cost of mining, which is obviously needed to validate the transactions, some of the miners have been having to sell the Bitcoin that they make to keep the lights on, to keep the computers working. And that's caused a bit of pressure. And some of them have actually ended up being taken out by the strong players. And I think this period here is where all that's been happening. The big boys have been literally stealing Bitcoin and stealing capacity and machines off people that are going bust. And I think we're just about to explode because we've now got the liquidity surge to come as well on the back of that. So keep an eye out. And this trading channel, 68, 69,000 and testing that 74 level eventually. But, I think we're definitely going to have a test of that, whether it just means we're consolidating the pattern or not. But then the trend back on the metrics, that can be anywhere. My own projections were sort of 240,000 by the next halving. Is a very easily achievable if it just decreases its price movement between each halving at the same rate. That would still be 4 times higher, etc., etc. And some people have got 20. I've got 1.5 million. Van Eck has got 1.5 million target by 2050. Well, that's only, if you work that out, that's only 16% move year on year, compounding rates. So it's highly likely Bitcoin moves a lot higher than that, because you've got a fixed supply and it's hitting mainstream. Like I said, the ironic thing will be that just as blockchain gets introduced by the central banks, centralized systems at large, that will be the keystroke which makes everybody in the world accept the idea of Bitcoin and being decentralized and not being at the whim of anyone controlling and potentially taking their money away. So keep an eye on that. There you go. That's my one of my emails that you can send things to. My Alpha email is down at the moment, so we'll use that one instead. So that really for me is everything I want to talk about. Is anything else? Did we go through everything? Oh, there's 2 more things to talk about. That is the key. Stick to the rules, get paid. You'll notice more and more on our Discord. I mentioned it earlier. Keep sticking to the rules. Don't try and break the bank. Don't try and bring Alpha Capital down. Don't gamble. Don't have crazy strategies on. Don't group trade. Trade properly. Learn. Ask questions if you want to learn more. I'm here. There's lots of people ready to help on my chat. Psychology, trading ideas, just a helping hand. Don't feel like you're alone. Come on to this. Encourage people to come on to this anytime. You do get paid. The majority of people do get paid. We show the evidence. We're actually in a public forum that you can see how much we're paying out. Trust Alpha Capital. We're here to try and make you better. All our products are evolving to try and make you more profitable and able to take your trading journey forward. So stick with it. And on that, look at the last one. If anyone didn't hear it earlier, just a final reminder, the competition is back. Test your skills against the world. And for anyone my age, used to be a science fiction program called Space 1999. Ironically, the year we might be in for the market breakouts as it is. But they were based on the moon, Moonbase Alpha. So keep that in mind, Moonbase Alpha for super competitions, 1st to 31st of October. Look out for the entry criteria. That will be around next week, towards the end of next week. Anybody can enter, whether you're qualified or not already, but the prize is a qualified account. The top 30 get them 50K for the winner. Another 4 get 25. And then the next 10 get a 10K, and the final 15 get 5,000. They're not to be sniffed at. They are straight to the money stage. No evaluations required. So please enter. Tell your friends. That should be the biggest competition entry of all time. The boys are there for you. Keep supporting Alpha. Loved speaking to you today. Thanks for your questions. Please leave likes on the YouTube below. Send in lots of questions. We're there for you. We'll see you on Monday.